Hello there everybody. It's a beautiful day. As you can see, it's all bright, sunny and warm. Welcome back to Money Conversations with Magical, and thank you for creating time to listen into these videos. So today, ladies and gentlemen, I would like to speak about the interest rates for the money market funds and what factors influence those interest rates. You might have noticed that over time the rates keep changing, and you might be wondering what factors play a role in these interest rates. But before I do that, allow me to just do a quick recap of what a money market fund is. So a money market fund is one of the funds under the collective investment schemes, or what is called the mutual funds. It's a fund that provides you with liquidity, and it's a low risk kind of a fund. It's one fund that primarily invests in short-term debt securities such as commercial papers, as well as treasury bills, and also things like the fixed deposits. For further information, I will attach a link on the description of this video. Then you can get a longer brief on exactly what a money market fund is. But for now, let's get into what factors affect the interest rates for the money market funds. The first one is the central bank policies, monetary policies. Central banks, just like the CBK, control the monetary policies when they want to control inflation, economic growth, and other factors in the economy. So they set short-term interest rates, and these interest rates that they set affect the yield curve across the entire economy. One of the tools that central bank uses is called policy rate. Policy rate is the rate at which commercial banks get loans from the central bank. And so any change in this policy rate affects all the other rates in the economy. Somebody is calling me. I'll have to call back later. So that change in the interest in the policy rate affects all the other rates in the economy. So if the interest rates are lowered, then the money market funds rate go down. And if the interest rates are increased, the interest rates for the money market increase as well. Okay, I trust that we are together so far. The other factor that affects the money market interest rates is the inflation expectations. High rates of inflation reduces the purchasing power of money. So the government can increase interest rates to ensure that they are fighting inflation. So once the government does that, or through the central bank, then the underlying assets increase in the interest rates, and then that affects the interest rates for the money market as well. The other factor that comes into play is the issue of the supply and demand. Supply and demand affects the money market interest rates, because if the supply or the demand for, let's say, short-term debt securities like the treasury bills, if the demand is high, it means that the prices go up. And when the prices go up, then the returns or the interest rates go down. So inversely, when the interest rates for these treasury bills or the other debt securities go down, the money market rates as well come down inversely. And the opposite is true. If the demand is low, then the prices go down and the yields or the interest rates go up, which then means that the rates for the money markets as well go up. What other factor affects money market rates is the economic growth. The state of the economy plays a major role in the rates that the money market funds give. In growing economies, when the economy is growing, the government also then plays a role in fighting this inflation. So what they do is that they increase the interest rates so that they stop the high rising inflation to avoid overheating in the economy. So once they increase the interest rates, definitely the money market rates also increase. And during times when the economy is slowing down, then the opposite happens, that the government reduces the interest rates, which then means that the rates for the money markets also reduce. And this is the current situation we are in. If you've been monitoring the money market rates, since the beginning of the year, the rates have been on a downward trend. So if you look at the interest rates that the government or that the central bank has declared, they've gone down significantly, and this has largely affected the money market rates. The last factor that could affect the money market rates is the global economy. So global economy also plays a big role in the money market rates. For instance, if in the US the interest rates, whatever kind of interest rates are there, could affect liquidity globally, as well as the interest rates across various countries. So ladies and gentlemen, there are so many factors that play a role in what rates the fund managers give in their money market funds. So those rates, when you see them, it's not that the fund managers sit down and suck the figures, or those are not figures that they sit down and do picky ponky and decide this is what we are giving in the market. No, these are the factors, the various underlying factors that come into play to ensure that these are the rates that are in the market. So by understanding these factors, you can make more informed financial decisions with your money. So ladies and gentlemen, thank you so much. I welcome you to continue subscribing, as well as suggesting future conversations that we can have in this channel. Thank you.